So we can start while we wait for others to join. And so we are making progress with our curriculum. So the assignment that was sent, Abel, you didn't submit your assignment. What happened?
So we send it. Not, I cannot use trading view on my system.
Why can't you use TradingView in your system? What happened?
I downloaded it, like it's just like it's lagging. Everything was just lagging.
Don't download it. Just use it from Google Chrome. Don't download it. The app might be heavy for your system. Just use it directly from the website.
All right, so
Yeah, it will be better like that.
yes.
Okay. So we started with these topics, right? And we're able to talk about the three-phase market, introduction to market structure, support and resistance. Okay, so for today, I will focus on these two: candlestick formation, trends and trend lines. Candlestick formation, trends and trend lines. Okay. Do we have any questions from the previous stuff we did? Is anyone you didn't understand? Okay, so yes, Simeon.
Please, sir. Thank you, sir. I I think I would like maybe a bit more explanation on choppy market. I was looking at it in the afternoon, if I'm not mistaken, and at some point it was looking like this this other one. Is it rangy? Yes, at some point. So I don't want to mix it up. The clear like definition and distinction of what a choppy market is.
Okay, okay. So you want to know the difference between choppy market and ranging market? Is that your question?
More like that. Actually, if a ranging market, like Mr. Destiny said, it's not like a trendy market like upward down trade. It's almost confined to a space. You just have maybe support resistance like that. So I think I am still a bit more clear on ranging market, but it's that choppy market that I'm not maybe 55%.
Okay, just a minute.
All right, sir.
The original description of a choppy market is, let me show you by image. You know, like, that's why we have different people take this class because, how will I say? Okay, just a minute. Let me show you something. the really the choppy market is not something that is very common. It's not that you'll be seeing it every time. But most times you will see a choppy market during bank holidays. Bank holidays. And because there is no activity in the market, you'll be seeing the market skipping. The market skips. I'm trying to get an image, but the ones I'm seeing are not clear. First of all, the characteristics of choppy market is you see there will be gaps in between candles. Number two, you will see a lot of wicks, candle wicks. You will see a lot of candle wicks, a lot of it. So these are, and number three, the market is neither moving within a range, it's just up, down, like that. Well, let me share this. Hopefully you can see. Hopefully you'll be able to see it. Can you see this? Is it visible?
Yes, sir. Can you zoom it, sir?
It will not be
Maybe a bit
clear.
more. Oh, okay.
It will not be clear. Let me see. Because the image itself is small. Uh, what about this one? It won't be clear. But if you look at it, you will see gaps. You will see gaps,
Oh.
breaking of the candles, gaps like that. Can you see it? Gaps,
Yes,
gaps.
yes, sir. The one on the
Exactly.
left is even more visible, and then the one closer to the right also.
Exactly. So it's characterized by those gaps. Secondly, it's characterized by a lot of, you can see these gaps. So it usually happens during bank holidays. It's not that it's not too frequent. It doesn't occur too frequent. To my own understanding and experience, it doesn't occur too frequently. It occurs during bank holidays. Okay. Let's try. The last bank holiday was a bit far. I would have said we check. Okay. This was a Monday, 14th. There was a bank holiday. Let me see if it affected the market. So let's check Euro USD. Let's check Euro USD. Let's see if by any means it affected the market. Fourteenth will be this day. So 14, let's just mark it. Let's see if it's affected it by any way. So usually the activities those days are not too strong in the market. Let me go. It wasn't really choppy, but it was ranging. 15 minutes. So this is more of a ranging market. 5 minutes. Let me see. Okay. So it was ranging, more of ranging. First of all, look at this gap here. The holiday. Let me check 1 minute. Well, that's just the difference anyways, for clarity purpose. Yeah, I can't see my this thing again. Where did I mark now? 1 minute. Okay. So it was more of a raging market. But that chopping market, most times you will see it when there are not so much activities on the chart. So that's the difference. That's the difference. Okay. Do you understand, or you need further explanation?
I think I get it better now.
Okay. So
Those gaps make it more clear.
yes, sometimes you see gaps, sometimes you see a lot of weeks. I can remember, the thing is I can't really find it on the charts now. There was a holiday, GBP USD. There was a lot of weeks. The market was just in a range, and you will be seeing a lot of candle wicks, a lot of candle wicks during that time. I think it was last month or so. Either last month. Can't really remember. But you will see things like this, a lot of it, multiple weeks in the range. In the range. So that's what characterizes the choppy market, really. Something like this. The candles are not, the proportion of the candles are not equal, and it just continues for a long time. The chart will just be scattered like this. So this is like an example of the choppy market.
All right, sir. Okay, sir.
Yeah. Another example is this, like this. You just be seeing weeks, weeks, weeks. You know, in a ranging market, the ranging market is more orderly. So you might see something like this. In a ranging market, really, you might see something like this. At least equal highs, most times equal lows. But look at this in this market here. There is nothing equal here per se. It's just scattered. So this is an example of a choppy market. So most times you will see gaps, especially when there's bank holidays. Secondly, you will see a lot of wicks, and candle sizes are not equal, they're not balanced. So yeah. Okay. So let's go on with what we have today. So we are looking at this. I think there was a news today. Let me see, because the way the market is looking. Yes. So today is Wednesday. There was CPI. That is why you see the market like this. So like we discussed about fundamental analysis. This is the action of retail traders. They are taking advantage of the news. So as you can see, there was news for GBP, and it was positive. That was why you see the buy, right? So like I said, you can always click here to read about the news. This is more on prices of goods, services purchased. So when you see green, it means positive. When you see red, it means negative. So this was positive for GBP, as you can see here, GBP. Then there was a news for USD. As you can see, it was negative. Hence, GBP USD did this massive buy. Let me see. Let me measure the pip. So this is like 79 pip movement, or it's even higher to this point. And I think the buyers took it up to this point, then sellers took advantage of it. So the idea is that anytime there is news in the market, anytime there is any news event, expect either a buy or a sell. And the effect of news is long run, right? It's not just at the immediate. News events affects the market even at the long run. So for example, we should be expecting more of some buys too for GBP USD from this point now onward. Normally, when there is a news event, you will see movements like this. But when the market is calm, it begins to tilt towards the direction of the news. So GBP USD is good as at the moment. So at least from now to the end of the week, you might see a little bit of more buys. Yeah, a little bit of more buys. So this is how practically news affects trading. Don't take it for granted as a trader. News affects trading. Let me measure correctly from here up to this point. So it almost 119 pip movement. This is $119,000. This is also 11,900 plus for some other person. Depends on your lot size. This is also $1,019. This is also $119. So it depends on the traders. They made a lot of money from this news. So like I said, CPI is one of the major news. And for USD, I think it comes out it comes out two or three times within a month, but the major ones I think comes out first Friday of every new month, something like that for USD. And other pairs have it on Wednesdays. So I'm just showing us what happened today in the markets, right? So we can check other pairs like, let's see gold. We see the same thing. Now, this is not what I'm supposed to teach today. No, let me not teach you guys this. But just know that, okay, look at this chart. Look at this chart. Is there any difference? It's almost the same thing. There are pairs that have positive correlations. Positive correlation. So most times anything Zhao USD is doing, BTC US, GBP USD is almost doing the same thing. If you check for BTC, it's different. It's because it's a cryptocurrency. Now look at this US oil. You will see the same thing, but in the opposite direction. Why? Because the base currency is USD. So look at what is happening here. It's the same with what is happening here, but the opposite and here. Okay, I think that's enough. Let's go back to what we're supposed to talk about. Yeah. Okay. I just did a brief summary of what happened in the market today. So let's go to what we're supposed to talk about. Now, we already talked about the three phases of the market, which is the uptrend, downtrend, and either a consolidation or what is it called now? A ranging market. Then we have the choppy market, right? So we all understand what that is. So even this, what you see here is an example of a ranging market. Here, an example of a ranging market. So it's the popular ones are is either the market is uptrending or it's downtrending or the market is consolidating. So you see those things very common in the market. Now, if you're following me, just drop one in the chat box. Somebody is raising hands. Abel, yes.
Yes, I wanted to ask the consolidation and what's it called now? The ranging market. Are they similar?
It's the same.
It's the same thing, just the name.
Yes, it's the same thing, but some traders call it ranging, while others call it consolidation. So it's the same thing. Okay. Is there any other question? No. So let me talk about a little bit of support and resistance. Support and resistance. Now, support and resistance, when you look at the forex market, there is always a position where the market stops. There is not really stops. Let me use the word hesitates. Yes, you always notice that there are some points where market makes hesitation. For example, here, one, the market made hesitation here, one here, made the same thing here. Made the same here, made the same here. So there is a reason why the market touched here once, touched here, second time, touched here the third time, and it was not able to break it until the fourth. And even when it came here the fourth time, it hesitated, right? It hesitated a little bit of around this region before the market broke through. And you see the market making another hesitation here and here. Now, there is support and resistance in the market. Support and resistance. Now, you can go from the monthly time frame. When you shrink your chart, it gives you a broader picture of what is going on in the market. Just a minute, I don't know, some loading. This guy, this guy is too busy. Okay. £22. Well, anyways, let me just explain. Now, this is pure technical analysis now. You can use this tool, this horizontal line, to mark out levels from the high tip. Now, there are two ways to draw trend lines or just general lines on the chart. The first is you want to put it on the tip of the wick. The second is you might want to use this line charts to focus on the close. You see that there is a gap here. And the reason why there's a gap there is because the body of this candle closed around this point while the wick got to this point. So it's either you are drawing to touch the body close, right? Or you are drawing to touch the wick close, whichever one. I think I should talk about candles first. Okay, let me just continue. So you can use your horizontal line to draw on it. At least you need two touches for it to form either a support or a resistance. So the reason why we're drawing this one here is because there is a touch here, there's another touch here. So you can see that there is another resistance here. 1, 2, right? So resistance, if we want to use just a layman's definition, it prevents the market from going towards the upside. So it serves like a ceiling. Use it like, just think about it like a ceiling. So it forms like a hindrance. While support actually serves as a base, like the floor, like a base where the market bounces off. Like you see here, it bounced off here, 1, 2, 3, and 4. Now, there is what we call zones. Now, support and resistance can also be known as key levels. So key levels are also known as support and resistance, key levels. And these key levels, you can mark the key levels from different time frames. So you have your resistance here, resistance. Okay, you have your resistance, you have your support here. Now, I was talking about zones. Now, a zone is a region in the chart where the previous support becomes a resistance. For example, here is a zone in this market. It's a zone. So previously, we see that this place was a support for this market. So the market bounced off here, bounced off here. Then it later broke this support level. It broke it. Then it became a resistance. So this place is marked as a zone in the market. It's a zone in the market, as a zone in the market. So you have support resistance similar to key levels. Then you have your zone. You have your zones. Okay. All right, so moving on. When we go to lower time frames, we can actually draw, because the more you go on the lower time frames, you see more key levels or support and resistance to draw on your chart. So this is from the weekly time frame, right? So if you look deep into this chart, you'll see that there is a level here, just about here. So if we take it a bit high, so there is one here, touch here, one touch here, one touch here. And it's almost like a bounce, okay? So you can see more levels into it. I think these guys, they only provide you 2006 data. That's why it's short. You should see actually more data. So on a daily, when you open, you'll be able to see, when you shrink your chart, you'll be able to see more levels that you can mark as support and resistance levels. So you can mark this level here, or let's say this, yeah, so one here, one touch here. So we can also mark this level. Yeah, this is on a daily. So the reason why the market has been hesitating where it is because there is a level here. Now, if you keep doing this, you will realize that your chart might not be too nice, to get a bit messy. So if you get familiar with your chart, like for GBP USD now, I can easily tell where there is a support level and resistance level. So when you get familiar with your chart, you will see that you become one with it. Now, like I said at the beginning of the class, the market does not just stop at a region just like that. So there is a reason why the market stopped here, which is, if you check previously, right? If you check previously, the market has come to that region before. The market has come to that region before, and the reason why it's there is because it was once a resistance. So usually when market comes to a resistance, a previous resistance zone, you will see a hesitation. You will see a hesitation. So this helps you to know when to keep buying or when to stop buying, or when to expect that, oh, at this level, the market will make a reversal. So the market is bouncing off this level now because previously it has bounced off this level and it's coming here, it's bouncing off this level. So you watch the reaction here. So as a trader now, you shouldn't be too quick to make a decision at this area because you know that the market has bounced. In fact, it was once a resistance, as you can see. It was a resistance before and it broke it, and now it's retesting it 1, 2. So this is a zone now. It's a zone. So this helps you when you are trading to know where the market can easily make a hesitation, because as a trader now, you plan your trade. You don't just dive into the market. You plan your trade. So you wait for price to react at your key levels, your zones, your support and resistance. Please, this is very basic, but it's really important. Your trades, if you truly in the forex market, if you want to catch the big moves, you need to learn to wait for areas of support and resistance, key level zones. Yes, support, resistance, key level zones, key levels or zones rather. So you must learn to wait for those areas, because from those areas, the market makes massive moves after the hesitations. After the hesitation. So these lines we drew from the higher time frames, you see that whenever the market comes there, the market does something. It reacts. It reacts. So support and resistance is very basic, but it's very key to entries. Entries. When you want to buy, for example, this region now is from the daily, it's already showing you that there is a demand zone here. So you might just be expecting a push up of price from this level because there is a demand zone here. And it's also traders will always wait at these regions, these key levels, these zones, to take actions on their trades. So key levels, support, resistance, and zones. Is there any question from this? No question. Okay. So let's go on. What I typed. Okay. So let's talk about candlestick formation now. Candlestick formation. Candlestick formation.
We identify around 100 individuals based on traditional method.
Okay, so let's use these candles, this one and this one. So normally, this is a candlestick. This is a bearish candlestick. This is a bearish candlestick. And there are three things you need to, is it 3 or 4 things you might need to know? 4 or 3. So the first thing you might need to know with the candlestick is the price. This guy. Okay, let me use another instead. So you need to know the open, the close, the high, and the low. The open, the close, the high, and the low. Now, generally, this is the structure of a candle. For a bearish candle, this is the open. For a bearish candle, this is the open. And this area is the close. So it means the candle opens from this point, right? And it closes at this point, and another new candle forms. There's another new candle forming. Now, this is called the wick of the candle. This you see, or this. It's called the wick of the candle. The wick of the candle. The wick. It's just like this candle wick, normal candle wick. So it's called the wick of the candle, while this part is called the body of the candle. The body of the candle. Now, normally, if you check here, if you check this point, it just gives you information about the candle. So any candle you move to, you just see the information about the candle. As you can see, it keeps changing. Tells you the high. The O is for the open, the H is high, L low, and open, high, low, and close. So and it gives you the percentage movement, right? So this is the candle. So it has the open, close, body, and the wick. So it's the same thing for the bearish candle as well. It has the open, it has the close, it has a wick. Now, sometimes for this open, bullish candle is different. The open is down. This is the open. And this is the close. And this is the body, of course, the body of the candle. So you have the close here, the candle closes here to open another candle. And on and on like that. It opens here, closes here, and this is the body, this is the wick. So this is how candles form on the chart. They open, they close, high point, low point, the body. So this is how candles form on the chart, right? Now, there is an explanation to the wick formation, the wick formation. So let's use this, for example. This shows, let me shrink this a bit. Let me use this. So from this candle now, you will see that there is a very massive buying pressure, right? A very massive buying pressure. Up to this point, actually. The wick forms when the sellers in this example try to push the market down and the market closed here. So as you can see, it was a bearish candle that opened. The sellers continued. Really, when this market opened, the buyers tried to take the market up this week. And then the sellers took it down. It just shows you the activities of buying and selling in the market. So this candle opens here. The buyers took it up. And in turn, the sellers took it down. The buyers took it up again and closed. This is more like an indecision in the market. So what I'm saying is, when you see a wick, just know that there's an opposite movement in the market first, then either the bears or the bulls, either one. So in this case now, as this candle opened here, it was the buyers that took the candle upward to this point, but the sellers brought it back and more like overpowered the buyers and brought it to this point and it closed. So this just shows you that there was buying activities. Now this week we draw, or we are marking out. If we go to a lower time frame, you will see that this will represent green candles. Why? Because it is the activities of buyers that is in the market that made this week. I wish we can get this. Sometimes it's difficult. Let me see if I can get it. Just this. So when you say a week on a higher time frame, understand that. Can I find it? Okay, is it here? Let me see if I can find it on a daily. So you see, that week represents these two green candles. These two green candles, because the buyers tried to take the market up, but the sellers brought it back down. So that is how wicks are formed. So just have it in mind that when you see a wick from a higher time frame, it signifies either the bears trying to take the market down, but the bulls overtook with a higher buying pressure, or the bulls trying to take the market up and the bears took it down back with a higher selling pressure. Do we understand up to this point? If you're following
Yes,
me, drop number 1 on the chat. I think I have 7 students here, but only 2.
Oh, yeah, Lagos.
All right. So let's move on. Let's move on. We're still talking about candlestick formation. Candlestick formation. So there are a lot of patterns. You know, there are chart patterns, there are candlestick patterns as well. There are candlestick patterns as well. So really, when you understand market structure, you understand chart patterns, and you understand candlestick formations, you'll be a very good trader, plus your risk management and all of that. Because when you look at the chart, the market forms structures. This structure is a combination of patterns. So you have structure. This structure, when you break or look inside structure, what you will see is chart patterns. Chart patterns. Inside chart patterns, what you will see is candlestick formations. Candlestick formations. Structure, market structure, market structure. When you see a market structure, if you break it down, what you see is chart patterns. When you break chart patterns down, what you will see inside is candlestick formations or candlestick patterns. So we discussed about structure, right, already. So structure tells you about the general movement of the market. So for example, if you take from this point to this point here, is a structure. Is a structure on its own. So within the structure, we have chart patterns. Chart patterns. So let's go to lower time frames to see the kinds of chart patterns we're going to find within that structure. So we discussed about structure, that the market moves in highs, lows, or impulsive and correctional moves. So the market makes impulsive moves, it makes correctional moves. So on a daily time frame, this is still what we are seeing here. Now, the chart patterns we have, there are a lot of them, many of them. There's head and shoulder, there is double bottom, there is double top, there is triple top, triple bottom, many chart patterns, many chart patterns. Now, when we go to even the 4-hour time frame to see clearer what kind of chart patterns are inside the structure that we're seeing. So there are a lot of chart patterns we're going to see. For example, you can see here, it's more like a triple bottom here. So on this trend line, you can see this is a W chart pattern. It's a W chart pattern. This is still that structure we're analyzing. Okay, let me shrink it. If I shrink it, you won't really see. But this is like a W chart pattern, right? So don't forget, inside the structure, you see chart patterns. So there are various chart patterns that you can see with names. Falling wedge, rising wedge. You can see bullish flag. There are many chart patterns. Like we have not reached there yet, so let me know. Sorry, let me not go ahead of myself. But just know that within structures, you see a lot of patterns. And inside the chart patterns, you are going to see candlestick formations. So there are various types of candles. There are various types of candles that the market prints. Various kinds of candles that the market prints. So let me just show. Let me show some of them. There are many. And I would really encourage us to, we might not be able to touch everything here, but there are apps you can download to learn market structure and candlestick formations. There are lots of apps that can help you to accomplish that. So go on your Google Play or your App Store, download some apps that will help you to understand the chart patterns and candlestick formations. So let me just show some of the most common ones. So we have the doji candle, although there are different types of doji. There is this is a dragonfly doji. Largely, this is a doji candle. Largely, it's a candle that is formed with wick, sometimes no body at all, like in this case, or a little body. So what this candle signifies is indecision in the market. So the buyers want to take the market up, the sellers are taking it down. At the end of the day, the candle closed at the middle, so it's indecision. So there is doji, the doji candle. Now we also have the pin bar, and it's either on the bullish or bearish side. So, and the way the candle forms, this is a pin bar. This is also a pin bar. This is also a pin bar candle. So this candle, the psychology behind it is that either the bears or the bulls tries to take the candle to the up or the downside. Then the opposite, okay, for example, in this case now, You see that the buyers tried to take the candle or the market to the upside, while the sellers brought it back down, and it closed with a small body. So a pin bar just has a small body with a long wick, either to the up or the downside, like this to the up or downside. And it doesn't matter if it's a green candle or a red candle. So this is a pin bar candle. It's a pin bar candle. Okay. So, okay, first of all, these are called Japanese candlesticks. Permit me, I didn't say that. Japanese candlesticks. So, then we have the bullish engulfing or bearish engulfing. Bullish engulfing or bearish engulfing. So this is a clear example. Actually, this is entering into candlestick patterns already. So normally in the single candles, you just need to know the dragonfly doji or the doji candle, more like a T. So a candle without a body, really just long wicks. You need to know the hammer candle, which is more like the hammer and the pin bar is the same, like this. This is a hammer candle. And all of them, they have the psychology behind it, and we're going to go into it. We also have a candle called Marbuzo. A Marbuzo candle is something like this. Well, this has a wick, but sometimes it doesn't have a wick at all. So a Marbuzo candle shows you either in this case now, it shows you a very massive bullish pressure. So whenever you see a Marbuzo candle, it just tells you that there is a very strong, either to the downside or to the upside, pressure in the market. Now, when you go to the lower time frames, you see a lot of Marbuzo candles without wick. Sometimes no wick at the top or the bottom or both sides. I can't really find anyone here without wick, but I think if you go to 4 hours time frame, you might see a Marbuzo candle. So it's called Marbuzo. So whenever you see that, just know there is a strong pressure, a strong, very, very strong pressure, very, very strong pressure, either on the bullish side or on the bearish side. Do we have any question so far? Do we have any question? Okay, so I hope we're understanding the teaching, right?
Yes, we're following.
All right, so now, when you just know the candles, each one, now, there are times when, I told us about structure, chart patterns, then within chart patterns, you see candlestick formation or candlestick patterns. Let me use the right word, candlestick patterns. So you will see 1, 2, 3, or 4 candles coming together and forming a pattern. So there are names for it, and they have a psychology behind it. They have a psychology behind it. So let me start with the one I already mentioned. There is a candlestick pattern called bearish or bullish engulfing. Bearish or bullish engulfing. Let me go to the weekly. This is a very typical example of it here. So now, please let me say this, and it's very important. Chart patterns and candlestick patterns are mostly relevant on key levels, support and resistance, and zones. I'll repeat it again. Candlestick formations and chart patterns are very relevant, mostly relevant on key levels, support and resistance, or zones. So the candlestick patterns I'm about to show you, there is not everywhere you see them that it will be effective in the market. Sometimes you can see them randomly in the market. Doesn't mean it will be effective. For example, this is a bullish engulfing, a bullish engulfing. And what made this very strong is because there is a key level here. There is a key level here. So a bullish engulfing candle, first of all, you find it on a preceding downtrend or uptrend. So it's either on the bullish side or the bearish side. In this case, this is a bullish engulfing. So you find it on a preceding downtrend. So there was a downtrend from this point here, right? And from this point here, the market reversed. So how do you find a bullish engulfing candle? First of all, you see a red small candle that's on the bullish side now. And of course, I think we know what bullish means now. I think so. You should have done that business.
Yeah.
Moses, what are you saying no to?
You were asking if we had questions before.
Oh, okay. All right. So you see a red short candle. Sometimes it's a pin bar, sometimes it can be a doji. So it just tells you that the bears, they're taking the market down. Then this candle forms a very small body. Then the next candle you see is a massive bullish candle that engulfs both the small candle and the previous candle. Really, it's just this. But for more confirmation, most traders will they enter in when this covers both this candle, the small one, and the previous one. So we can spot bearish engulfing. Another example is here. This is a bearish engulfing. And what that means is expect a massive reversal of that market to the opposite direction. So where you see, for example, we see a bullish engulfing here and the market bought. We see another one here and the market bought. So you can check, of course, another one here, the market bought. So it's a very common one here. This is a bearish engulfing. So this red candle engulfed the green one. And what did you see? A sell. So this is the first candlestick pattern I'm teaching us. Bullish or bearish engulfing. Bullish or bearish engulfing. Right? So from let's see this. Okay, it's not what happens here. But from here, now in Forex, not all of the things we teach does not occur 100% of the time, but most of the time it happens. So you must understand that. So in order, or in case you are backtesting and you're saying, oh, it didn't happen here, it didn't happen. It's not all the time it happens, but most of the time it happens. So it just tells you that the bears at this point, they lose momentum. So the bulls took charge of the market and they led the price to the upside. So bearish or bullish engulfing is a confluence most times for an entry in the market. Bearish or bullish engulfing. So the idea is that you will find it on a key level. Please, this is very important. When I started out, I was looking for patterns everywhere in the market. No, it's effective on key levels. So this is a key level, and you see the market board. This is a key level. So whenever you see these patterns on a key level, you see this one is close to this key level. They are stronger on key levels. Look at this on a key level. You might see a bearish engulfing at the middle of nowhere. Please, if it's not close, this is by experience anyways. It is not close to key levels. It is not effective. If it's not close to key levels, it's not effective. So the chart patterns and the what is it called now? Chart patterns and candlestick patterns. Please look for them on key levels. They are more effective on key levels or support or resistance zones. Okay, so for trading this now, you have to wait for the next candle to close above the high of the green candle to confirm that this is okay. What I mean is this. Let's say you want to enter for a trade here now at this point. Then you see this candle just engulfs this. For a confirmation, wait for another open of this next candle to close above the high of this candle before you make your entry. I hope we understand. So if you want to buy from here now, and you see, okay, there is an engulfing candle, yes. So you can wait for a confirmation on this candle. Not from this higher time frame anyways, from a lower time frame, before you can enter for your buy, right? For example, look at this. Let's say this is the engulfing bullish candle. If you didn't wait for a confirmation for a green candle to at least close above this high, at least this is how it's traded. So let's say you just jump and enter somewhere around here and you put your stop here because you are excited about this. This candle will just take you up. But look at this confirmation. If you had waited, for example, that this candle closes above this and you buy around here, look at this massive move up. So it's always best to wait for, when there is an engulfing candle, wait for the next candle to close above the engulfing candle itself. I don't know if you understand, if we understand what I'm saying.
Yes.
All right. So let's move on to another candlestick pattern. There is a candlestick pattern called piercing. Will I be able to find this one here? Piercing. Let me see. Might be difficult to find. It might be difficult to find. Yes, I think it is this one. Now, do you see that there's something? No, it's not this. Not this. But there's a candlestick called piercing. And the psychology behind that is that the bears, let's say in a downtrend now, the bears lose momentum, right? And you will see a gap. I think I should just draw so I will understand. Let's say this is a candle that has been forming on a downtrend. Candle has been going on a downtrend, right? There's a candle has been going on a downtrend. Then the next candle that pops up does not open at this close. You see a little gap here. And the next candle that opens is a bullish candle. And it closes above 50%. Let's say this is, yes, 50% of this candle. 50% of this candle. So this candle opens with this gap here. You see a gap, usually piercing. Now, all of this, please go online, search, you will see. So there is a gap like here. But the idea is this bullish candle closes 50% above this. This signifies a massive, I don't know, as you have been checking your chart, how many of us have been observing gaps? How many of us have been observing gaps in the market? Yes, Simeon.
I'm confirming what you're saying, Sam. I've seen gaps before.
Okay. So how many other persons have noticed or observed that the market forms a lot of gaps? While you are trading, the market forms many gaps. Okay, Moses, you have seen it. So for this piercing candlestick pattern, like let's say, for example, a preceding downtrend, then the candle that pops up with a gap here, right, is a bullish candle, and it closes 50% above the previous bearish candle. So it shows you that the bears lose momentum, and the bulls now are in the market, and they'll push the market up. It might be difficult for me to find. This is a gap here, but it doesn't really describe what I'm talking about. But most times when you see a gap, most times, not all the time anyways, most times when you see gaps, it just tell you the pressure and volume that is in the market, high volatility. So you see the market skipping like ram. There's high volume of volatility in the market at that time. Okay, so that's piercing. Then there is tweezer bottom. Tweezer bottom is more of a red candle followed by a green one, almost equal heights, something like this, but it's more of they are equal heights. Tweezer, it's called tweezer bottom. There's tweezer bottom, there's tweezer top, I think so. Is Mr. Destiny here? Okay. Let me see if I can find it on a lower time frame. So There is a candlestick pattern called tweezer bottom. Something like this. These two candles, this red and this one. Yeah. So just these two, this one and this one. So you see equal height. Sometimes they might have wicks, sometimes they don't have wicks. So this is an example of tweezer bottom. So it just shows you that the market refuses to go below this price, right? It's suggesting, let me use the word, suggesting that market refuses to go below that price. So once the market, or this bearish touch this level, it bounces back. So it might just tell you that there is buying pressure. So all of these I've been talking about is on the bearish side. So its opposite is the same for the the bullish side. Opposite is the same for the bearish side. So tweezer bottom, two candles equal of length. You see, it forms a lot in the market. It's very common, tweezer bottom. So again, these candles are, these candlestick patterns are very effective when you see them on. Okay, look at these two, the same. So this is for the bearish side. So you see the massive sell. Yeah, tweezer top, equal candles. Look at this. So it's very common as you go and backtest, check for tweezer bottom or tweezer top. So still on the bullish candlestick patterns, we have the three white soldiers. Three white soldiers. How can I find the three white soldiers here? Three white soldiers. So it's a candle that forms three candlesticks, really three candlesticks. And if it's on, as we're talking about the bullish side, it will be green candlesticks, three candlesticks. So you also see it on a preceding downtrend. You see it on a preceding downtrend. A preceding downtrend. So it shows you that the bears are exhausted and the bulls are in. They are in. It forms something like this, just about this, but it's preceding downtrend. Let me see if I can find. If I can't find, please, you just go online and check. So it's called three white soldiers. Three white soldiers. Anyways, maybe I can just draw. So you will see a candle like this. So on a preceding downtrend, you see three bullish candles. Let's say there is a massive candle like this from the bearish side down to this place, right? Immediately it closes. You see three candles like this. Three white soldiers. So it just shows you the presence of the bulls in the market, and is a signal for a buying, a buy. So we also have a morning star. Oh, morning star, it's one of my favorites. Morning star. Morning star. I think we can find it here. Yes, so this is an example of a morning star. So a morning star candle, you find it on a preceding downtrend. So this is a morning star, these three candles. So there is a bearish candle, then there is either a pin bar or a doji, then there is a bullish candle. So these three candles forms a morning star. So opposite is the evening star, which is these three candles. So usually there is a kind of a little gap, sometimes you will see. But the idea is from this bullish side now, if this candle forms and it forms a pin bar or a doji, this candle must close, this third candle must close at least 50% of this other candle. Do we understand? Morning star is three candles, either on a preceding downtrend or a preceding downtrend, whichever, uptrend or downtrend. So for the downtrend, this is called a morning star. For the uptrend, when you see it here, it's called evening star. But the idea is when you see the bearish candle and the pin bar or doji, the third candle must close 50% above this first candle to confirm that is a morning star. And also the reverse for this. This third candle must close 50% above this first candle to confirm that it's a morning star. So that candlestick pattern is very common. Very, very common. Look at it from a lower time frame, from 4 hours. You see a lot of morning star, evening star candles. Yeah, so this is an example of it. This is an example of it. This is also an example because this closed, I think, a little bit 50% below it. So this is an example of an evening star candle. Sketchy name. What does that mean? Mr. Julian. Mr. Leon, what do you mean by sketchy name? No response. Okay, so there you have it.
Good morning, Sabine.
Oh, okay. So this, now let me just reiterate on what I've said, the major ones actually. So we have the bullish candlestick patterns and we have the bearish, although I was trying to talk about the two at the same time, but I hope we're not confused. So the bullish candlestick patterns, you will find them in or on a preceding downtrend. So all of the bullish candlestick patterns, you'll be finding them on a preceding downtrend. After a downtrend, then you find them. Like example, this is a morning star. Although it is not close 50%, so we can't really count this as a morning star. But you will find them mostly on after a preceding downtrend and on a support resistance level or zones or key levels, whichever one. So we have the dragonfly doji as a normal candlestick, the hammer as a normal candlestick. But when you put these candlesticks together, you begin to have the candlestick patterns like the bullish engulfing, the piercing candle, the tweezer bottom, the three white soldiers, and the morning star. Now, on the bearish side, you'll find it after a preceding uptrend. I hope I'm not confusing us. After a preceding uptrend. Now, for the bullish candle, you have dragonfly doji, but on the bearish side, you have gravestone doji. All these names are gravestone. Let me see. So it's more like an inverted T. Inverted T. So you find something like this, gravestone doji. This is dragonfly doji, right? This one is a dragonfly doji. It's more like a T on the top side. But the flip side of it is the gravestone doji. So the T, yeah, something like this, but more of a thinner body. So that's for the bearish side. Now, we have the shooting star. You know, for the bullish, I told us about the hammer, right? Hammer, something like this, but a little bit of smaller body. So we have the hammer on the bullish side, but on the bearish side, we have the shooting star. See, you might not cram all of these names. So this is an example of a shooting star. You might not cram them, but just learn to identify them. So we also have bearish engulfing, then For the piercing, I don't know why they are changing all this thing. For the piercing, you have the dark cloud cover. Dark cloud cover. Then you have the tweezer top, 3 black crows, and the evening star. So you have for the bearish, and you also have for the bullish candlestick patterns. Candlestick pattern. Okay, so I think we've talked about. Does anybody have any? Okay, let me just about trend line briefly, so we can call it a day. Trend line. Now, for a trend line, a trend line connects 2 points on the chart. So point 1, 2, 3. So at least 2 points. So this is a trend line. It just shows you the direction of the market. So of course, we know that this market is trending to the upside. Now, the trend line must pass the relevancy test. The relevancy test in the sense that, as you can see, as we drew this trend line, it is still relevant based on this structure we're seeing here. So the market is still touched here. Okay, let's say it touched here, and it's at this point now. So this trend line is still relevant. So there are 2 things generally price can do when it gets to a trend line. It can either serve as like a support for the market to bounce, or it can either break the trend line, retest it to move to the opposite direction. So either it can serve as a bounce, or it can break the trend line. And once it breaks the trend line, that trend line loses its relevancy. So you have to find another place to draw another trend line. So there are times where you can let me go on the lower time frame. There are times where you can see trend line like here now. It's not only from the bottom, you can draw a trend line from the top to this point. There are times when also you can put the chart within. For example, I think you can see something from here. It's like the market is within a channel. All of this is what you can use the trend line to do. So it's within a channel. So you can see a touch here, a touch here, a touch here, a touch here, a touch here. So trend line just guides you to know that first the trend of the market, possible areas on which the market can touch and bounce on, and also it can show you where the market can break out from. To either the upside or the downside. Trend lines. So you can actually, as a trader, when you go to the lower time frames, you see that there are more opportunities for you to draw more trend lines. So you can actually pick a trend line from the 4-hour, and when you go to the lower time frames, you can even see more areas where you can draw trend lines. But the use of trend line, you just have to be careful. Like Mr. Destiny always says, drawing too much of lines in the chart can get you confused. So just draw, at least for beginners level, draw few that you can understand. It's not necessarily when your chart is full of lines that you're making the money, no. Just draw the ones that is okay and that will not confuse you. When there are too many lines, unless, of course, you can remember the lines, but when there are too many lines, it can actually confuse you. And like I said, when drawing trend lines, you can either draw to touch the wick, or you can draw them to touch the body. So it's your choice. For example, if you use this line, you'll see that there are gaps. So some people prefer to draw the trend line with the line to touch the real body close. The real body close instead of the wick. So if you put on the normal candle, you see that it's as though it's above it, but this line shows you that it's touching the close of the candles instead of the wick. So whichever one you want to use is your choice. Trend lines. Trend lines, trends and trend lines. So we know the trends, the uptrends, downtrends, and the consolidation, choppy market, all of that. So we did that yesterday. So we already covered the support and resistance. We've introduced the market structure. And I told us that when you see a structure, within the structure, you will see chart patterns. So we're going to talk more about chart patterns. So within chart patterns, you also see candlestick patterns. And all of these, as you break it down to the lower time frames, you will see more of these structures within structures, patterns within patterns, and